Hi, good day all. Welcome to chapter 1 of our practical finance course. Today we're going to talk about basic concepts you should know when dealing with finance and especially with business cases. Stay tuned. First of all, I would like to talk about the concept of time value of money. This is the most important concept of all if we want to work in finance. The perfect world does not exist. Unless you live alone on an island without any contact with the exterior world, you will always live with the joke that the money changes value over time. And it can change its value in both directions, increasing its value, what is known as appreciation, or down, decreasing its value, what is known as depreciation. The first one, appreciation, is perhaps more manageable by people, maybe because most of us are oriented in increasing the value of our positions. We're used to gain money at the bank, not losing. We want our money to increase, to grow. We might buy bonuses or stocks at the stock market. We sometimes call it protect our money. But protect it from who? From thieves? From burglars? No, that's not it. And we know in our deep conscious level that it's not a who, it's a what. And that what is precisely the second concept we're going to deal with. And it's called the inflation. Inflation is an economic process that causes prices of goods, commodities, services to increase, which means that spending the same amount of money all the time will lead us in buying less and less of those goods and services. Inflation is calculated through the use of a price index, which is a weighted average of the prices of a selected basket of goods and services measured every month. Then the increase, or in rare occasions decrease, of this price index is represented as a percentage to calculate the inflation rate. Okay, so grasping again that protect concept we used before, our goal is always to increase the value of our money over time, in spite of inflation. And because inflation will always be present because we don't live on that island, it means that no matter what we do, money loses value over time. So we just need to gain over of what we know is happening, that money is losing value. So that brings us to our next concept, the concept of present value. Present value, it's simply the value that the money has today. Okay, so we already know what happens if we keep $100 in our closet for a decade. If we decide to buy something today with that money, what we can buy now will be much more of a particular product of what we can buy in 10 years from now. Or standing at the other end, what we are buying with these $100 today is much less of what we could have bought 10 years ago. The face value of the bill hasn't changed, it's the same bill. So finance had to come up with something that distinguishes value from what something is worth. Worth is the level at which something deserves to be valued. So the concept of present value is what money is worth today. And there is a formula for that, a formula that we will visit in our next chapter, a formula that deflects or adjusts a future value into a present value. And in order to make operations, adds and subtracts with cash flows from different periods of time, we need to bring them to a single period of time. And what better period of time than today, the present? So that's what present value is about. And all these explanations lead us to our next two concepts, nominal value and real value. When we speak about nominal value, we are talking about a value that's never been adjusted or deflected by that formula, so is the face value of the bill we just talked about. When we speak about real value, we speak of a nominal value that has been deflected by the use of the present value formula, or that has been appreciated by the future value formula, which is the same but cleared differently. Generally, we use the nominal value for almost everything, unless there is a big gap between the nominal values and real values. Let's see an example. Henry Ford, back in 1914, in order to incentivize the production of his new car model, he doubled the daily wages to all employees at the T model production line. He doubled from $250 to $5 a day. That's the nominal value. That was a huge salary back then, especially for production line workers. Today, it doesn't seem much, of course. If we bring that value from 1914 to the present, it is equivalent to $130 real value, which is a more decent salary nowadays, considering it's $130 per day. Also, it is known that the Manhattan Island, where part of New York City is today, was bought in 1626 to the Lenape Native Americans by Mr. Peter Minuit, a Dutch guy who wanted to build the city of New Amsterdam. And it was bought for 60 guilders worth of trade, equivalent to around $24 nominal value of 1626. If we bring that to the present, to 2020, it's equivalent to $1,143 of today, real value. Well, this time not as much as we thought. Also, not a very decent trade for the Lenapes indeed. Our next concept is a discount rate. The discount rate, also known as cost of capital, is the opportunity cost of making a specific investment. It is like the rate of return that could have been earned by putting the same amount of money into another investment with the same risk. So the term has embedded the notion of risk. The higher the risk, the higher the discount rate will be. An investor will surely evaluate not only the possible return of his investment, but also the risk that is involved. So, if a very risky project is presented to him or to her with a low return, say 5%, he or she will surely prefer to a lower return in a very low risk investment, like say the treasury bonds, which yield around 2% a year. The discount rate considers the following aspects: risk and liquidity of the market of the project, which we already talked about, inflation rate of the country where the project is going to be, operational and financial conditions of the company responsible for making the project, and the amount of financing the project needs. All these four aspects are important in determining the adequate discount rate of the project. Another important concept is the business case. The business case is a document that includes the justifications for the undertaking of a project based on estimations. It is like a selling tool needed to convince the future investors, but not to deceive them with fake arguments. In the contrary, it's a way to give them confidence and certainty that the investment that they are about to make is well backed up with adequate market researches, financial analysis, etc. Our next concept is the internal rate of return. The best way to define it is using our previous concept. So, it is the discount rate needed to neither win nor lose money in a project, or what we call break-even. That means that all the project cash flows, what we bring to the present value, at this discount rate is equal to the investment. Payback is our next concept, and very well related to both concepts we're talking about. It has to do with the period of time in which we are in break-even. This time we bring to present value at the defined discount rate all the cash flows of a certain period of time. And when we obtain break-even, then that is the payback period. That period of time of cash flows that we bring to the present is the payback period. Our last concept is the profitability index. It is just a measure of the sum of all present values of cash flows, not including the initial investment, divided by the initial investment. So it is like all the money a project returns for a given investment. It is usually measured in percentage, or at least that's what I like to do. So if we have a profitability index of 100%, that means that we're in break-even. Less than that is a no-no project. More than that, go for it. Well, enough for today. Thank you very much, and please stay tuned. Remember to subscribe. Thank you.